Thank you for joining us for this month's National Economic Outlook, written by Local Market Monitors founder Ingo Windsor. Ingo is a graduate of MIT and Boston University, and he's not your typical economist. He has a knack for presenting complex facts in an easily understandable way. So without further ado, I'll turn it over to Ingo.
Thank you very much, Julie. Every month, we look at the latest data to see what they can tell us about the economy and about real estate markets, where they are now and where they may be headed. You make better investments when you have a better idea of the forces that affect supply and demand. This month, we'll look at new reduced estimates of job growth. We'll try to separate the effects of recent government actions from longer-term trends, and we'll try to draw conclusions about what may happen the rest of this year and in 2027. First, let's look at the revisions the Bureau of Labor Statistics has made for estimates of job growth in the past 2 years. There's a before picture and an after picture. This is the before picture. It shows the percent growth of jobs every month compared to the same month of the previous year. There are two ways the BLS calculates job numbers. One, shown here in red, is from data submitted by all employers every quarter. So it's the most accurate picture we can get. But it takes many months to collect and process the numbers. So, in addition, it also conducts a survey of businesses every month to get more up-to-date data. The survey data are shown here in blue. Those are the numbers we read about in the press every month. And now let's see the revised numbers. Here's the after picture. In this chart, we see exactly the same red numbers and the revised blue numbers. I'll switch back one more time. Old numbers, new numbers. Starting from the same level at the start of 2024, the revised numbers show that there was slower job growth throughout the last 2 years than we had thought. Well, so what? The estimates are revised every year. What's the point of showing the difference, especially since both sets of numbers end up at the same place with very low job growth in the last months? Here are just the blue numbers. The difference to my mind is why we look at charts at all. We're trying to spot trends that will help us see what's likely to happen in the future. And what the revised numbers suggest to me is that slower job growth didn't just happen suddenly. It's been here all along, which means it won't suddenly recover when cuts to the federal workforce are over, for example. We've been on a downward slide for years, and it will continue during 2026 and probably 2027. A look at the job growth in the various sectors of the economy may help us understand the underlying situation. First, of course, are the big cuts in federal government. Now 10% of the federal workforce, 300,000 jobs eliminated. But it's not just federal jobs that have been lost, also jobs at the state level. Which means overall that government, the largest single employment sector of the economy and usually a stabilizing economic force, is providing no help for the economy. The situation is pretty much the same, although not as bad, in the construction sector. No job losses overall, but also no growth. There's little growth in non-residential construction, except maybe for data centers, who knows? And there are continuing job losses in home building. The revised numbers show larger job losses in manufacturing and smaller but chronic losses in the retail sector. After signs of life earlier this year, jobs are again down in finance. And the job situation has been volatile at restaurants, which employ a lot of immigrants. So where is the economy adding jobs? Only in healthcare. A bad sign for any economy, because healthcare, unless it can be exported, is just a transfer payment from one set of people to another. It doesn't create anything. If our hospitals were filled with people from other countries who pay a full price, as happens with many of our colleges, this would be a plus for the economy, but they're not. And despite the good growth of healthcare jobs overall, it's important to note sharply lower growth in home healthcare, one of the largest subsectors, where much of the work is done by immigrants, legal and otherwise. The final sector we'll look at is business services. Lawyers, accountants, office cleaning, the services that all other businesses need in order to operate, and usually our best indicator of actual business activity. It's been losing jobs for years. Partly that's because temporary workers are still being laid off. But so are highly paid computer programmers. So what we're seeing is weakness in all sectors of the economy except for healthcare. How much of that is due to recent government policies? In other words, if those policies were altered, how much of a rebound in jobs might we see, and how quickly? Here's the start of job growth again, with the red portion highlighting data since January of 2025, when many new government policies were started. If you just draw a straight line down with a ruler, it's not difficult to imagine that the deterioration in growth is just a continuation of the previous slowing. On the other hand, the higher growth rate at the left of the chart in early 2024 can also be seen as just the last rebound of hiring from pandemic losses, with growth in the second half of 2024 settling in at around 1%. In that case, all of the slowing since then is due to government actions. It's certainly true that jobs in government, construction, and home health care have been sharply affected, and even the loss of computer jobs may be connected. In times of uncertainty, one of the first costs businesses and agencies cut is their spending on computer services. But the answer isn't clear, which means the uncertainty is high, and that by itself is a depressing force on an economy that has been trending towards lower growth for a long time. That's because some forces are larger than government actions, and one of them is the growth of the population. This chart shows the growth of the US population every year since 2010. The purple portion shows the natural growth, more people born than dying, and the green portion shows the growth due to immigration. And it shows that population growth has been well below the historical average of 1% a year, and slowing down even before the pandemic, especially the natural growth. Because the US economy is driven by consumer spending, slower population growth inevitably means slower economic growth. It's as simple as that. The only way to increase economic growth in this situation is to increase immigration. That's what we see right after the pandemic. But the data from 2025 show that this has come to an end, with immigration only half of what it was in 2024. And probably even less, because the measurement takes place halfway through the year, and anti-immigration actions increased in the second half of 2025. This is the alarming part of what lies ahead in 2026 and 2027, the likelihood that immigration will be close to zero for a while, with dire effects on the economy. And if the economy stalls, we'll see a reckoning in the real estate markets where prices will readjust downward to match incomes. Overpriced markets always eventually readjust. That hasn't happened yet, but we already see hints in Florida, often the leader in home price changes. That's it. In this time of uncertainty, it's important for bankers and investors to stay on top of local economic and real estate developments. Local Market Monitor provides the data and analysis they need with local market reports and investors' metro analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.